If you bought 10 shares of McDonald's when they IPO'd on April 21st, 1965, and you held them, you didn't do a thing, didn't add to them, how many shares would you have right now today? Hey, what's up? I'm Russ, and this is Dapper Dividends, where we are helping you build tomorrow's passive income today. So we don't believe in getting rich quick around here. We know this takes time and it takes consistency, and we need to be investing in companies for that passive income that's largely stable and growing. So growing is the key. So let's take a look at McDonald's, who just announced that they're increasing their dividend by 7%. This is really cool because inflation is currently sitting at about 5.3%. So a 7% hike is going to help us beat and pace inflation and give us more money for doing nothing at all. The McDonald's board of directors has raised the quarterly cash dividend to $1.38 per share, payable on December 15th, 2021. Now, you do need to hold those shares by close of business on December 1st, 2021. And that new dividend will be $1.38 per share, which is equivalent to $5.52 annually. So while we love those McDividends, and while that's very important, they've also announced that they are going to resume the share repurchase program. And why this is so important on top of dividends is because when there are less shares to spread the earnings per share out across, that's going to increase the value of the stock because we're increasing the earnings per share per stock. If we look at companiesmarketcap.com, check that out. They have McDonald's ranked as the 69th most valuable company according to their data by market cap. And we see that $184 billion market cap was reached by them being a strong company and going up and to the right consistently over the last 20 years. Peeking at the revenue chart, check it out. In 2012, they had a revenue of $28 billion. Now, revenue is the top line growth. That's just all the money coming in. That is without deducting any interest or expenses, and that's just the money they got coming in the door. So that top line has been dropping since 2012. So that's something to keep in mind as a potential investment. But when we look at the earnings, we can see in 2012 it was about $8.7 billion. It did dip a little bit, so it's been kind of choppy. And they were at $9.5 billion in 2016. So yes, while the revenue has been decreasing a bit, it's still at least nice to see that their earnings, which is going to help be boosted by the share buybacks. So that's always something to keep in mind. You don't want to see them taking on too much debt to buy back shares because that is not a good way to grow. But if a company is making good revenue and they're growing the top and bottom line, then they safely can buy back these shares. A very simple test you can use is to see if products are in store shelves or if people are using them. So while I was out running errands this morning, I swung by this McDonald's in Lemont, Illinois, and look at that. There were cars. I couldn't get the shot by the time I ran up there, but there was cars backed out into the street. People were actually pulling away because they were hanging out in the street. Fantastic to see. Tons of customers. People are constantly using McDonald's. So I always try to look at the pros and cons of a company. And some of the cons that could be a little bit better that I see are they have increasing debt. They have about $35 billion of net debt. So personally, I'd also like to see them aggressively paying down that debt, maybe more so than buying back shares, because they're buying those shares back at 30 times earnings, which I think is a little bit expensive for such a mature company like McDonald's. We saw their revenue was declining. We saw their earnings were a bit choppy. And this is something to keep an eye on as competition comes in, as people become more health conscious. We need to look at how is McDonald's going to innovate to cater to people, to the general public's changing desires. And this is something I love about business, is that any entity's first order of business is its own survival, its own rational self-interest. So very cool to see what they're going to come out with in the future. What I do like is their commitment to increasing that dividend, which has been increasing for 45 years now, since the inception of the dividend in 1976. and their also commitment to buying back shares. Those are two really strong features that I like. They feed 1% of the world's population every day, so there's a fun fact for you if you didn't know that. They also have fast, cheap, and convenient food, which is what people know and love them for and want to keep buying McDonald's. I like that they are one of the world's leading real estate companies. People don't like to think of them as a real estate entity, but they own almost all the land that they lease out to the franchisees. And also the pricing power. McDonald's has really strong pricing power, meaning that if they raise their prices, most people are still going to pay those increased prices. So McDonald's is a defensive blue chip core holding in my opinion, but I do think it's a little bit overvalued right now. But then you also have to think, if 10 years from now McDonald's was $500 a share to say, then is it overvalued now? People that bought McDonald's when it was $50 a share might have thought it was overvalued. So you have to know what game you're playing, and the longer you hold, the safer you will be. So if you're buying and holding for years and decades, then I would be comfortable with starting a position here and then adding heavy on any pullbacks, because I don't think McDonald's is going anywhere. And if you're not comfortable buying an individual company, then why not buy them inside of an ETF? You can buy the VTI, the Vanguard Total Market ETF, and in doing so, you would be exposed to about 21 million shares of McDonald's, worth about $5 billion. So if you had bought 10 shares of McDonald's at their IPO on April 21st, 1965, how many shares would you have today? This is from McDonald's investor relation page. If you scroll down, we see they have had 12 stock splits in their history since they went public in 1965. So beginning in 1966, if you were to have 10 shares and then be split for the 3-for-2, which would give you 15 shares, your 10 would magically turn into 15. You would have 7,290 shares of McDonald's had you bought 10 shares at the exact IPO price of $22.50. So $225 in 1965 would be worth $1.79 million currently. And you would have 7,290 shares for doing nothing else. Now, I know most of you know what a stock split is, but if you're new around here and you don't know what a stock split is, there's also something called a reverse stock split, which is very important to understand and know what that is, like General Electric just did with their reverse stock split. And if you don't know what that is, click the video right here and I'll explain to you what it is there and why it's important, and I will see you there.